The Relative Strength Index, commonly known as RSI, is a powerful technical indicator used by traders worldwide. It helps identify overbought and oversold conditions in the market, giving traders valuable insights into potential price reversals. Throughout this tutorial, you'll learn how to use RSI effectively in your trading strategy. RSI is a momentum oscillator that measures both the speed and magnitude of price movements. It operates on a scale from 0 to 100, making it easy to read and interpret. The primary purpose of RSI is to identify when an asset is overbought or oversold, helping traders anticipate potential price reversals before they happen. The RSI formula is RSI equals 100 minus the quantity 100 divided by the quantity 1 plus RS here. RS stands for relative strength, which is calculated by dividing the average gain by the average loss over a specific period. The standard period used is 14 days, though traders can adjust this based on their trading style and time frame. The RSI scale is divided into 3 key zones. The oversold zone ranges from 0 to 30, indicated in green. The neutral zone spans from 30 to 70, shown in yellow. The overbought zone extends from 70 to 100, marked in red. Understanding these zones is crucial for interpreting RSI signals correctly. When RSI rises above 70, the asset is considered overbought. This suggests the asset may be overvalued or experiencing excessive buying pressure. An overbought condition often signals that a price correction or downward reversal may be imminent. Traders typically interpret this as a potential opportunity to sell or take profits on their existing positions. When RSI falls below 30, the asset is considered oversold. This indicates the asset may be undervalued or facing excessive selling pressure. An oversold condition often signals that a price bounce or upward reversal may be coming soon. Traders usually view this as a potential opportunity to buy or enter new positions at favorable prices. While RSI is a valuable tool, it should never be used in isolation. Always combine it with other technical indicators and analysis methods for better accuracy. It's important to note that during strong trends, RSI can remain in overbought or oversold zones for extended periods without a reversal occurring. Remember, RSI helps identify potential reversal points, but you should always confirm these signals with additional analysis before making trading decisions.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.